We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Brian Hirschman, managing partner of Hirschman Capital. Thanks for joining me today, Brian. Good to have you back here.
Hey, Tom, it's great to be back on the show.
It's been a little while. I can't believe it's been over a year since we've chatted last. But, there's never a dull moment, it seems like, in the finance space here. And, having this, I would say, time between our podcasts, we can go back and look to what we talked about last time and kind of gain some perspective from that. So maybe we could start by talking a little bit about how you value or forecast the gold price. Because again, having this time between podcasts, it's interesting to go back to have this perspective that you do and to see, let's say, where you were right and where you were wrong.
Sure. Yeah. Gold is very interesting because although it's one of the oldest asset classes in the world, it seems like it's also one of the least understood asset classes. And the best example of that is that most investors don't seem to understand how to value gold. They think that because gold doesn't produce cash flow the way that real estate or equities do, then it can't be valued. But that doesn't make sense to me because you can value lots of other assets that don't produce cash flow. For example, you can forecast exchange rates and currencies using things like the Big Mac index, and you can value the stock market using the market capitalization to GDP ratio, which doesn't directly involve cash flow and is actually Warren Buffett's preferred way of valuing the stock market. Now, I don't want to give away the exact way that I value gold because one of my competitors could listen to this podcast. But what I will say is the method I use would have accurately predicted the long-term movements in the gold price over the last 50 years or so since the US Bretton Woods gold standard ended in 1971. And the key point, I think, is that gold's valuation is currently below its 50-year average, which I think is just incredible given all the things that we'll probably talk about on the show today that have the potential to cause gold to skyrocket over the next few years. And if we talk about forecasting the gold price, I think there's three things we should also discuss that affect the value of gold, the valuation of gold. And the first is inflation, which when inflation increases, it reduces the value of payments in the future, which is why bonds tend to decline in value when inflation increases because principal payments and coupon payments far in the future decrease in value. But gold, of course, it doesn't depend on payments far in the future, so its value doesn't decline when inflation increases. And so when inflation increases, you tend to see a shift from assets like bonds to gold, and that causes gold's valuation and the gold price to increase. And that's an important reason why gold did so well in the 1970s when inflation was rising in the US and in many other countries. The second important thing that you should consider when thinking about the gold price's value is defaults, because equities and bonds, they're of course exposed to default risk. When defaults increase, those asset classes tend to decline in value. But gold, as the cliche goes, is the one asset that is nobody's obligation. It's immune to default risk. As a result, when concern about defaults and defaults increases, investors tend to shift from bonds and equities to gold. And we saw a small version of that earlier this year when there was the banking crisis in the US and investors shifted to gold, at least temporarily. The third thing that has a significant impact on the gold price is real interest rates, since higher real interest rates tend to make other assets like money market funds look more attractive relative to gold, which doesn't pay interest. But I think contrary to the popular wisdom, the effect of rising real interest rates, the negative effect of rising real interest rates on gold is much smaller than the potential benefit from inflation for the gold price. And as evidence of that, we can look at the 1970s. Then you had inflation concerns increasing, and you also had rising real interest rates. yet the gold price did incredibly well. And as another example, in the 80s and 90s, you had falling real interest rates and also falling concern about inflation. And as a result, the gold price did not do well in the 80s and 90s, despite the benefit of falling real interest rates. But I think the most important point is that gold's valuation is below its 50-year average. And as I'm sure we'll talk about today, there's a lot of things on the horizon that could cause its valuation to increase dramatically over the next few years.
Yeah, it's interesting to think about these different cases of inflation. Obviously, we're going to get to a couple later in the show here, but drove them and what was able to bring them under control, I think is really interesting to contrast those differences. But, if gold should benefit from inflation, why has it not performed better over the last 2 to 3 years, considering the consumer price led inflation that we've seen so much of?
Yeah, it's a great question. The last 2 to 3 years have been strange for sure. I think inflation got up to almost 9% last year, and the core CPI has been above 4% for 24 months now. Yet despite that big increase in inflation, bond investors still expect only 2% annual inflation over the next 5 years. In other words, they're extremely confident that the recent inflation is going to be temporary. But if that changes, then I think that's when we'll see the potentially huge increase in the gold price. If we look at the 1970s as an example, inflation expectations in 1974 were around 4% or so. And then by 1980, by inflation expectations, I mean what investors were expecting for annual inflation over the subsequent 5 years, inflation expectations increased from around 4% per year to around 7.5% per year. And when that happened, the gold price went from around $150 to around $700. And I think if investors eventually change their opinion and conclude that inflation is not going to be temporary and that we're likely to have sustained high inflation, and that's what I expect to inevitably happen, then we'll see a similar percentage increase in the gold price. The problem over recent years is that investors have viewed the recent inflation as temporary, but I think it's just a matter of time before they conclude that the inflation is likely to be sustained. And that's when we'll see the increase in the bond market's inflation expectations. And that's when we'll see the dramatic increase in the gold price and in gold's valuation. That's when we should see those things.
Brian, do you think that there's a difference between what you see as the path forward for US inflation versus the rest of the world?
Yeah, I think there's a lot of different things that affect inflation. And I think globally, you have factors such as supply shortages and labor shortages. And another thing that can affect inflation is simple increases in the money supply due to money printing. But what's unique about the US, not completely unique, but is a especially bad problem in the US, is the US government's high debt. Because one of the other things that can cause high inflation is if a government's debt is too high. If investors conclude that a government is going to have to print money to pay off its high debt, then they're going to dump its currency, and that will cause inflation. And examples of that would be 1920s Weimar Germany, as well as present-day Argentina, Turkey, or Venezuela. And what's uniquely bad about the US, and this is a problem in other places, but it's especially a problem in the US, is the US has this combination, this toxic combination of 4 factors. And those are high government debt to GDP, high budget deficits, high inflation, and high borrowing from foreigners. And the reason why those things are such a problem is if you have a combination of high budget deficits and high government debt to GDP, then that means a government's debt is likely growing faster than its capacity to pay, since the budget deficit is a proxy for the rate at which government debt is growing. And high borrowing from foreigners is a problem because foreign investors tend to be more flighty and they're more difficult to control with regulations. And there's lots of historical evidence that countries that borrow more from foreigners tend to default sooner and tend to have debt crises more often and tend to have higher inflation. And the problem with high inflation, of course, is it means that a government has started to default through inflation, and therefore there's an elevated risk that it will continue to do so. And what I did recently is I went and looked at every instance of other countries with this combination of four factors over the last 100 years or so, since 1914. And I found 21 other examples. And I found that all 21 of those countries defaulted within 2 years, either through outright failure to pay or through large currency devaluation or through sustained high inflation. In fact, the median average annual inflation of those 21 countries over the subsequent 4 years was 18%. And in 0 of the 21 cases was the country able to avoid sustained high inflation with a recession or with some central bank policy or central bank rate hike. So that tells us that the US is in very bad company because it has this toxic combination of these four factors. And in fact, I would argue that the US's situation is even worse than most of those other countries because the US has unusually short debt maturities. And as we'll probably talk about later.
Right now, right?
Yes, especially right now. And in addition, we have the short-term floating rate debt issued by the Federal Reserve, which makes the effective maturity of the US government's debt even less because every time the Fed hikes interest rates, that leads to more losses at the Federal Reserve. And since the Fed is part of the government, that effectively makes the overall government debt situation and government deficit worse. And so, and another thing that makes the US's current situation especially bad, as I'm sure we'll touch on later, is we also have a bubble in real estate and a bubble in US equities. And when those inevitably burst, it'll be a disaster for the US government's finances. So that's why I think inflation in the US is an especially high risk.
So, Brian, I'd like to talk a little bit about, let's say, examples of some of these 21 instances where these countries had these four factors. Would 1800s Britain and, let's say, present day Japan be examples of governments that avoided default and high inflation despite high government debt?
Yeah, I think it's a great question because people often argue that the UK is, because the UK had high government debt in the early 1800s, that means the US government's current high debt is not a problem. But I think that argument is silly for a number of reasons. The first is the UK government in the early 1800s pretty much only spent money on defense, whereas the US government today primarily spends money on entitlements, things like Medicare, Medicaid, and Social Security. That matters because as soon as the UK defeated the French, defeated Napoleon at the Battle of Waterloo in 1815, they started running steady surpluses. And as a result, they were able to steadily reduce their debt to GDP ratio, steady budget surpluses, government budget surpluses. Whereas the US's current situation is completely different. They're expected to run budget deficits for as far as the eye can see. For example, Larry Summers, the former Secretary of the Treasury, recently said that he expected the US to have roughly a 10% budget deficit over the next decade. And I think he was actually being optimistic. So the US's situation is simply not comparable to the budget surpluses that the UK was running in the early 1800s. Another important difference versus the UK is the UK didn't borrow much from foreigners. And as we were just talking about, foreigners tend to be more flighty. And so it's a big advantage if you don't have to borrow from them. A third big difference is the UK in the early 1800s had a huge overseas empire. For example, by 1819, they controlled nearly all of India, which had a GDP that was 2 to 3 times as big as that of the British Isles. So if you look at the debt to GDP ratio for the British Empire, which is probably the better way to look at it because the empire had significant and large impacts on the economy of the British Isles, then the debt to GDP ratio for the British Empire was much lower than it was for the British Isles. And then despite all those advantages, the UK still defaulted by suspending the convertibility of the pound into gold in 1797 in response to a bank run that was triggered by a French invasion. And thus by 1809 or so, the British pound had lost half of its value relative to gold. And I think the pound in British bonds would have lost even more of their value if the war against the French hadn't gone as well as it did. And switching to Japan, I think there's two important reasons why the Japanese bond bubble has lasted as long as it has. The first is what we were just talking about. Japan hasn't borrowed from foreigners. And so that's a big difference from the US's current situation where we borrow heavily from foreigners. A second important point about the Japanese bond bubble is that Japan hasn't had inflation until really the last year. And so we still haven't seen the full consequences of that inflation. And as we'll probably talk about in a minute, the consequences may turn out to be dramatic. And even despite that, I think it's very clear that Japan's current situation is precarious. If the borrowing cost of the Japanese government increases from its current 0.7% level to, let's say, 5.9%, then the government's interest expense will be greater than the government's entire tax revenue. And a 6% interest rate wouldn't be that high. That's just about 150 basis points above Japan's current core inflation. And of course, they would default well before interest rates got to 6% because they also have Social Security spending and defense spending that they can't cut. So they would never be able to actually allocate all their tax revenue to interest expense. So the Japanese situation seems like a time bomb. And the other important thing to remember about Japan is another reason why their bubble has lasted so long is that the Bank of Japan has bought Japanese government bonds worth 100% of GDP. And as part of that strategy, the Japanese central bank has kept short-term interest rates at close to 0% because that keeps the borrowing cost for the Bank of Japan lower. And that also keeps the government's borrowing cost lower, which makes the budget deficit better. But the problem with that is that since inflation has increased and the Bank of Japan has held deposit rates at zero, that now means that Japanese savers, Japanese depositors are getting a negative 3.3% return on their deposit accounts, adjusting for inflation, which is actually the lowest deposit rate in 50 years. So what will be interesting to watch over the next few months and over the next few years is if Japanese depositors start to pull their deposits from Japanese commercial banks, just as US depositors pulled their deposits from US commercial banks earlier this year. And if those Japanese depositors decide to invest in things like gold or equities or real estate or foreign investments or other debt securities instead of deposits, then that could potentially be a big problem for the Bank of Japan because it would lead to deposit flight at commercial banks. And then Japanese commercial banks would in turn have to pull deposits from the Bank of Japan. And the Bank of Japan uses those deposits to fund its bond purchases, its quantitative easing. And that has been one of the key, as I just mentioned, was one of the key reasons the Japanese bond bubble has lasted so long. And so if the Bank of Japan starts experiencing deposit flight from Japanese commercial banks, then it will need to either sell government bonds, which would of course cause the Japanese bond market to start selling off, or the Japanese central bank would need to start printing currency, which would be inflationary, or it would need to start raising interest rates to try to stop the deposit flight. But that's a problem because it would increase losses at the Bank of Japan and also increase the Japanese government's budget deficit. So the Bank of Japan in that situation would be left with a lot of bad options, any one of which could potentially cause this bubble to burst. So it does seem like it's just a matter of time before the Japanese bond bubble ends. And so I don't think we should be comfortable about the US situation because of the Japanese bond market. They had advantages that we don't have, yet they still seem like they're in a very precarious situation.
Yeah, I just want to kind of reiterate one of those points that you made there, Brian. You're talking about possible deposit flight as like starting with commercial deposit flight. when the inflation adjusted rate of return on people's money is negative 3.3%. So it seems like that is an unavoidable outcome at this point.
Yeah, I think so. I think the situation was slightly different in the US because the US has a big money market fund industry. And so investors in money market funds and bank deposits, they're very similar credit risk. And so it was a very simple decision to switch to money market funds where US depositors could get a higher interest rate. The situation in Japan is different since they don't have the same kind of money market industry. But yeah, I would think it's only a matter of time before investors are going to say, why am I losing 3% every year when I could invest in gold instead? And if they were to shift to a foreign money market account, then they would have currency risk. So that's a little bit of a hard decision. But I think any government, it can't hold interest rates at large negative levels for a sustained period without something like capital controls. And they don't have capital controls. So yes, over time, I would expect that to That's a whole nother topic. So I would expect there to be some movement in Japanese deposits, and you're already starting to see anecdotal evidence of that, and it's also starting to show up in the Japanese deposit data in a small way.
Is it possible that capital flight could spark a crisis, let's say, by Japan's entire budget being consumed by their debt if their interest payments go that high to, 5.6%? If their interest rate on their debt got that high, their entire budget could be consumed by just their interest payments alone. Could that spark a debt crisis elsewhere because of the overall level of global debt at this time?
Yeah, absolutely. That's a great question. Global government debt to GDP is at an all-time high, and we have this situation where government debt in many countries is at levels that have almost always led to default. For instance, the last few times I was on this show, we talked about this study I did where I looked at every country over the last 200 years, and I found that every time a country had gross debt to GDP, government debt to GDP of 130% or higher, they defaulted. And that matters because right now the US, and the one exception, 51 out of 52 defaulted. The one exception was Japan. And as we just talked about with Japan, it just seems like a matter of time. But that matters also because the US is close to that threshold. We're at around 120% GDP now, and debt to GDP. And Italy is also well over that threshold. And there's a lot of other countries in the world where government debt is quite high, like the UK and France and Brazil. And so it seems the financial system, of course, has become more interconnected. And so it seems that if we have a government debt crisis in one country, then it could very easily spread across the world. And there's lots of historical examples where a government debt crisis in one country spread to nearby countries. For example, you had the Latin American debt crisis in the 1980s, and you had that with the Asian financial crisis in 1997, and you saw that with the European sovereign debt crisis after the global financial crisis. But the risk of that seems even higher now because government debt is high in so many places, and we may be seeing the beginning of that right now since interest rates are rising globally everywhere. But if that does happen, if we do get a global government debt crisis, that should be fantastic for gold.
It's kind of crazy to think that it is, both fantastic for gold, yet if we think about what the world is going to be like at that time, it's very looming and negative on the other side of that, just the gold price. But Brian, if we see this type of a debt collapse and of a debt crash coming here, could governments become the cause and not the cure of the next crisis?
Yeah, absolutely. I think that's one of the most dangerous things about the current situation is investors have become accustomed to always getting a government bailout. Really, for the last 40 years, every time we've had a minor little recession or a minor little crisis, the government has essentially stepped in to bail out the economy by cutting interest rates, or by doing a direct bailout. And I can list lots of examples. For instance, you had the rate cuts after the 87 stock market crash, after the 91 recession, after the 2000 dot-com crash, after the 2008 recession, after the COVID recession. And we had bailouts after long-term capital management in 1998 in Mexico in 1994. And the list goes on and on. You get the idea. The problem is now this kind of age of bailouts and crisis suppression, it might be coming to an end because government debt has reached insane levels in so many places. And so if investors, and once a government starts having a debt crisis, it loses its ability to bail out the private sector or to cut interest rates to bail out the rest of the economy. For example, if the US continues to default through inflation and then it causes some problem in the private sector, and then the US cuts interest rates in response, that's just going to make inflation worse. Or if investors lose confidence in the US's ability to pay its debts, and then the US steps in to bail out some bank or other private institution, then that's going to just make the government's fiscal situation look even worse because the government would be taking on even more liabilities. So the key point is we've seen this recently in countries like Argentina, Greece, and Turkey, where once the government starts having a debt crisis, it loses its ability to bail out the private sector. And investors they're not expecting that because for 40 years, they've gotten used to always getting a government bailout whenever there's any minor crisis in the economy. What we might see instead is a doom loop where there's a government debt crisis, and that in turn makes the private sector slow down, the private sector have a recession, and then the private sector recession in turn makes the government debt crisis worse. And that again is what has happened in places like Argentina, Greece, and Turkey. But it's something that investors in the US have not seen in 40 years.
Brian, we've talked about other bubbles on the show before, and obviously we spent a lot of time already talking about these global debt bubbles. Do you think the bubbles in equities, bonds, real estate, and even, let's say, China, for example, as we're seeing problems with their corporate debt now come to the surface again, do you think that these bubbles have gotten worse, or are they in any way, shape, or form somewhat rehabilitated since the last time we spoke?
Yeah, I think we still have those bubbles, and maybe I'll talk about why I think that's the case, and then maybe I'll talk about why I think the situation has gotten worse since I was last on the show in 2020. And just to explain the bubbles, for instance, there's one in the US stock market. I like to look at the cyclically adjusted price earnings ratio to value the US stock market. It's the ratio of the S&P 500's market cap to its average earnings over the prior decade. And the idea is there by looking at average earnings over the prior decade, then you're smoothing out the fluctuations due to the business cycle. And right now, the CAPE ratio for US equities is around 32x, which is more than double, or it's around 32x, which is more than double its long-term average of around 15. So that tells us that the US stock market would need to fall around 50% just to get back to a normal value. And that's the current CAPE ratio is even higher than it was on the eve of the Black Tuesday 1929 stock market crash, which led to the Great Depression. And as we were just talking about, I do think the US is headed for a sustained inflation crisis. And during the last US inflation crisis, during the 1970s and 1980s, the CAPE ratio fell all the way to 5, which means US equities could potentially fall 85% in an inflation crisis. And then in the real estate market, US real estate market, which is the second bubble I'll mention, I think the situation is even worse because price to rent ratios and price to income ratios for US residential real estate are now above their 2006 peaks, even though mortgage rates are the highest they've been since 2000. So to me, that represents what the economist J.K. Galbraith called the extreme brevity of the financial memory. Investors have forgotten all the lessons from the last housing bubble, even though it happened less than 2 decades ago. And then China, as you mentioned, that's also a dangerous bubble. You have a triple bubble in debt, construction, and real estate there. And the incredible thing is that the price to rent, I just said that the US housing market is in a dangerous situation because its price to rent ratio is near an all-time high. But the situation is even worse in China because their price to rent ratio is multiples of the US's price to rent multiple. In other words, their bubble is so big, it makes the biggest bubble in US history look modest. And China, of course, is very important because it was 40% of global GDP growth over the last 4 years. So if it slows significantly, it's going to cripple global growth. And we've already talked about the global bond bubble, and so I won't repeat that. But as far as why the current situation is even more dangerous, one reason is that this, and Jeremy Grantham of GMO has made this point. This is the first time in US history that we've had 3 bubbles all at the same time. In 1929, before the Great Depression, it was primarily just a stock market bubble, yet that still led to, and government debt was low and the real estate market was reasonably priced, but that still led to the Great Depression. If you look at Japan in the 1980s, they had 2 bubbles in equities and bonds, yet that still led, and government debt was relatively low, yet that still led to a lost decade for them. And their equity and stock markets still have not gotten back to where they were in 1989. Or if you look at the US in 2006, yes, we had a housing bubble, but government debt was less and the valuations in the stock market weren't nearly as elevated as they are now, yet that still almost caused a second Great Depression. So now we have this situation where we have 3 bubbles that could potentially burst all at once. And therefore, the next crisis seems like it could be far worse than any of the last 3 recessions in the US. And this is probably why Jim Rogers says the next bear market is likely to be the worst of our lifetime. And just to expand on that, the reason why I think they could all potentially collapse simultaneously, one, we've already talked about, if the US has a debt crisis, then it's going to blow up the US equity and US real estate markets. And so you would have all 3 bubbles collapsing at once. But alternatively, if the US housing market valuations continue to weaken there, then that's going to blow up the US government's finances. And so that would should either accelerate or trigger a US government debt crisis. So it seems like whatever bubble bursts first, it seems like it's going to bring down some of the other bubbles with it. And that's why this situation seems very dangerous. But as far as what's gotten worse since the first time we talked about these bubbles in 2020, I think there's 3 new trends that seem like they could cause the bubbles to collapse. And the first is what we've already talked about, inflation. I talked about how when countries have the US's toxic combination of those 4 factors, high debt, high deficits, high borrowing from foreigners, and high inflation, that usually means that we're going to see continued high inflation soon. It's not that the high inflation is 5 years away. It's not that the crisis is 5 years away. We're likely to see the crisis within 2 years. And so if we continue to have sustained high inflation, that should pop the bubbles. The other potential trend that could bring down these bubbles is recession. I know the market has become more optimistic that we're going to postpone or avoid a recession in recent months, but the fact remains that the Conference Board's leading economic index has never been this low without the US being in a recession. And probably as other people on the show have talked about, we have an inverted yield curve in the US. And we also have an inverted yield curve in 26 other countries across the world. And historically, the inverted yield curve has been a very good predictor of recession. So at a minimum, the risk of a recession is elevated. And the reason why that matters is if you look at the other prior super bubbles in history, such as the 1929 US stock market bubble and the 1980s Japanese real estate and equity bubbles, and the 2000 US stock market bubble and the 2006 US housing bubble, none of those bubbles survived a recession. So I'm skeptical that the current 3 will be able to do so. And then the last potential thing that could bring down the bubbles is momentum. We still have those 3 bubbles, but the valuations have been declining. For example, the CAPE ratio for US equities was 39 at the end of 2021. It's now, or in November 2021, it's now only around 31, 32. And in the bond market, the TIPS yield for Treasury inflation protected securities, it's gone from negative 1% in 2021 to around 2% now. And the price to rent ratio in US housing has started to come down, and it's started to come down even more in the Chinese real estate market. So it seems like although these bubbles are still bubbles, they're starting to deflate. And that matters, again, because if you look at the prior super bubbles in history that I just listed, 1929 in Japan and 2000 and 2006, once those bubbles started to deflate, they continued to deflate. It's not as if the CAPE went from 39 to 31 and then back up to 45. And so the short term is always impossible to predict, but it does seem like the combination of big bubbles and declining valuations is very dangerous. So to get back to your original question, that's why the current situation seems even more dangerous than when we first started talking about these high asset valuations in 2020.
Yeah, it seems like all of these bubbles have only grown and gotten very likely more dangerous since then. But considering the size of all of these bubbles, you said that in 2021, when we spoke, that gold could reach $6,000 in this crisis. Is that still your price target? And what do you kind of base that off of?
Yeah, I think since we last spoke in 2021 about where I think gold could trade in a severe inflation crisis, the consumer price index has increased and other things that I use to value gold have also increased. As a result, I now think that if gold returns to the same peak valuation that it reached in 1980 at the tail end of the last inflation crisis, I now think it should go above 7,000. And as we were just talking about, there's lots of reasons to think that the next crisis is going to be far worse than the 1970s one. So it's possible gold's valuation will go even higher. That said, I'm a value investor. So if gold is at 7,000, I'll probably have sold all my funds, gold mining investments, since we're not trying to hang on for the last dollar. And by the time gold gets to 7,000, there'll probably be incredible opportunities in more conventional asset classes like equities and real estate. And then as far as what that might mean for gold miners, I think if gold is at 7,000, then it's very easy. There's many companies in my funds portfolio, I think, that would could potentially trade at more than $800 per gold resource ounce. And if you look at the valuation of my portfolio June 30th, the average resource multiple for our companies was only around $25. So if they go from 25 to 800, that is, of course, a astronomical return. So seems like gold should go even higher in the next crisis than we last talked about this in 2021. And it seems like the potential upside for this sorts of small, safe gold miners that my fund owns is even higher.
Brian, if you wouldn't mind, can we go through that a little bit more? What do you mean by $800 per gold ounce? Is that what they're valuing each of their gold ounces at in the ground, or that they're producing? Explain that a little bit more if you could.
Yeah, how I'm coming up with that number is if right now, if you value, for instance, if you assume that the gold price is 7,000, it'll continue to be 7,000, then you can calculate the approximate present value of a gold mine, the cash flows it'll generate if the gold price is 7,000. And so if I do that for several of the companies in my portfolio, and I look at the present value of their future cash flows at $7,000, I get a certain present value. And then I look at what that present value is, and then I divide that present value by the number of gold resource ounces that the company currently owns. And for several of the companies in my portfolio, that suggests that the present value of the company at 7,000 is around $800 per gold resource ounce that the company currently has. So it's just a simple way of expressing how much these companies could potentially increase in value if the gold price soars.
Excellent. Thanks for explaining that a little bit more. You know, the GDXJ is down around 35% from the end of 2020. So why do you still think that gold mining companies haven't performed better over the last 2.5 years? This seems unproportional to the gold price, which you would think has a much higher beta to what gold miners should be worth.
Yeah, I think the basic problem and this goes back to something we were talking about earlier in the show, is that you've had a big increase in gold mining costs over the last 2.5 years because wages and equipment costs have been going up with general inflation. Yet you haven't had a big increase in the gold price because inflation expectations have stayed low. And as a result, investors haven't shifted from asset classes like bonds and equities to gold. But for all the reasons we discussed earlier, I expect sustained high inflation, and that should lead to higher inflation expectations and much higher gold prices. And so we should see something similar to the 1970s. In the 1970s, you had gold increase by around 400% from 1973 to 1980. Meanwhile, wages and steel prices in the US, and steel is another big cost component for gold miners, those only increased around 65% and 80% respectively. So over the course of the investment cycle, I expect gold prices to increase far more than mining costs, and that should be fantastic for profits of gold miners. And I think what's happened over the last 2.5 years, it should just be a temporary problem.
So, Brian, when we think about, let's say, current equity trends, AI has been really a big cause of the rally here. Do you think that AI could prevent a financial crisis that you're warning about?
Yeah, it's an interesting question. I'd go back to the study I mentioned earlier where I looked at all the countries since 1914 that had the US's same combination of those four toxic factors: high debt, high deficits, high inflation, and high borrowing from foreigners. Yet all 21 of those countries defaulted. And that's despite all the amazing technological innovations we've had since 1914. For instance, cars were invented, you had radio, television, lasers, refrigerators, computers, etc. Yet all that innovation wasn't able to prevent a debt crisis. And I'm skeptical that AI is going to be any different. Yes, AI will probably improve economic growth, or will almost certainly improve economic growth, but it's not going to be enough to prevent a US debt crisis or to prevent these bubbles from bursting.
Yeah, it doesn't seem like the advent of one piece of new technology can displace all of that history and be the solution to all of the problems that we're facing, because this is not a problem that AI created. And therefore, I don't see why it would necessarily be a solution that AI could bring about, because this can has been kicked down the road for so long that really seems like an unescapable situation, regardless of any type of new technology. We kind of have to face the music here.
Yeah, exactly. The stock market seems to disagree with us right now, but all past bubbles have burst, and I don't see why it's going to be any different now. If we want to go back to 1800, right, it's the same story. I mentioned earlier that study that went back to 1800, that I found that 51 out of 52 countries with 130% debt to GDP had defaulted. So even if we look at all the innovation in the 1800 with the Industrial Revolution and many other things, then it's the same story. So technology innovation helps growth, but when debt gets this high, then there's not much that can save you.
Brian, do you think one of the other problems, let's say, that the Fed and the US government are facing is a demographics issue that won't help with the growth of the economy or social entitlements?
Yeah, demographics are certainly contributing to the entitlements problem. And as I mentioned, that the entitlements problem is the major reason that the budget deficit outlook is so awful. There's other reasons why the deficit outlook is so awful, but that's a major reason. And demographics problem also means that the US economy is not going to grow as fast as it otherwise would. And that makes the debt problem worse. So it is an important reason why we're not going to be able to grow out of this. And I would just come back to, we talked about this a little bit last time. I oftentimes hear people argue that because of demographics, interest rates are going to stay low. That argument makes no sense to me, because there's been lots of other countries just in the last 20 years, such as the pigs in Europe, Portugal, Iceland, Ireland, Greece, and Spain and Italy, that had debt crises despite having aging populations. So that argument doesn't make sense to me. So demographics, yeah, it seems like a problem for the budget deficit, seems like a problem for our economic growth, but it doesn't seem like something that's going to keep interest rates low, as much as the bulls try to to grasp onto that argument, it's not supported by history.
Mm-hmm. Excellent, Brian. Well, that's most of the topics that I have set up here for today. Is there anything else that you'd like to mention before we wrap up?
No, this was great. Thank you very much for having me on the show, Tom.
Of course, Brian. It's always great to chat with you. It's interesting to do this a little bit more separated. And of course, if anybody wants more information about you or your fund, hcapital.llc and also on Twitter at hcapitalllc, right?
Perfect. Thank you.
Thank you, Brian. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.